All right. Good morning, everybody. Good morning and happy Thursday, everybody. Today is November 9th, 2023. Top story this morning is continuing jobless claims. They keep rising. Now, they're not shooting up. They're not taking a rocket to the moon or any of that stupid language. They're just ticking up month after month, week after week, slight increases in continuing claims. This is actually 8 consecutive weeks that we've seen continuing claims rise. Now, that's interesting because initial jobless claims are kind of flat. Let's talk about the numbers a little bit. Initial jobless claims, 217,000 this week. All right, that's down 3,000 from last week. They were 220 last week. Not a big change. So there's no sudden deluge of people losing their jobs. Although I would add that we are starting to see anecdotes, Square laying off a large percentage of their workforce, Operation Bora Bora or Project Bora Bora at Citigroup. So we're starting to see more stories of layoffs come in. Now, it takes a while for those anecdotes to reach the unemployment offices. So initial, not really any area of concern. They're actually pretty low. But the thing is, that's people who just lost their job. And what we're seeing is, even though the rate of people losing their jobs maybe isn't that alarming, once people lose their job, they're having a hard time finding new work because continuing claims just keeps continuing to rise. We had continuing claims were 1.834 million. That's up another 22,000. 8 consecutive weeks we've seen that on the rise. Now, last month, for the first time in a while, we saw an uptick in the unemployment rate from 3.8 to 3.9%. Now, a 0.1% increase in the unemployment rate is somewhere around 160,000 people staying on the unemployment roll. So doing a little bit of math here, if we continue at a rate of about 20,000 people staying on unemployment every week, that means about every other month we're going to see an uptick in unemployment of about 0.1%, which means this job market, we keep hearing about robust hiring, about the strength in the labor market, tightness in the labor market. The Fed wants to reduce tightness in the labor market. And I've been saying all this year that the labor market really isn't that tight, that we would see wages rising faster if the labor market was indeed that tight. And we wouldn't be seeing people having to work 2 jobs to make ends meet if the labor market was tight. They wouldn't have to. The demand for labor would be enough that the price of labor would be rising faster. And we're just not seeing that. So we've got continued weakness in the job market here. And keep in mind, guys, we've been talking a lot about mortgages these last 2 days. Right? Shout out to Melody Wright, who came on the channel yesterday, did an excellent job explaining to us some of the things that are going on in the mortgage industry right now. Even though the traditional financial press, they're just telling us everything is great. Oh, a sudden surge in demand for mortgages because of the lower rates we got last week. No mention of how the mechanics in the mortgage market, they're making a lot of noise right now. Did something break? I don't know. It's like the car didn't totally break down, but it's making that funny noise. Maybe pull over and take a look at what's going on in there. But no, you don't get any of that in the mainstream press. So if we get a surge in unemployment, if we keep seeing these tick ups week after week in continuing claims, even though it's a small number of people losing their job, they're not finding new work. Eventually, that is going to translate into the housing market, because when people lose their job, they become home sellers, whether they want to or not. Also in the news, guys, and I can't believe we're talking about this again already, we're 10 days away from another government shutdown. All right. Now, I'm not going to hyperventilate about the politics of the government shutdown. You guys could probably figure out where I lie on the political spectrum. And I don't mince any words about my opinion of the idiots in Congress and how they behave. And let's just not go there. But let's remember why the U.S. government's credit rating was cut back in August. And the thing is, regardless of what comes out of this sure to be ridiculous debate about the government shutdown, they're probably going to increase spending again. They're probably going to take it either right to the brink or right beyond the brink. So we'll probably get more of the stupidity in the press, more of the stupidity on TV and in the news cycle. And that could lead to higher interest rates in the bond market, because the reason why interest rates, or one of the reasons why they keep rising so fast, is because nobody has any confidence in our elected legislators' ability to manage their finances. And another government shutdown just a few weeks after the last one is just going to be another story about how these idiots in DC just can't get their act together. That could cause people to lose confidence in the U.S. government debt, which could lead to them demanding a higher interest rate in exchange for lending to the government. And with that, let's shrink my big melon of a head and see what's going on in the market today. And don't forget that like button, guys, while we're here. It really helps out with the YouTube algorithm. And hit that subscribe button if you're new. We get together every morning, have your coffee with the Melon Heads. Fear Greed Index is sitting at 40 right now, still in fear territory, heading back towards neutrality. I would just add that the CNN Fear Greed Index has been either in fear or extreme fear territory for the last 8 days, and the stock market has done nothing but go up for the last 8 days. Take from that what you will. The S&P 500 right now scheduled to be up again, 9.9 points up ahead of the opening bell. That is about 0.25% higher. Take a look at the chart of the S&P 500, guys. Just ridiculous. Up, 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 up. We recaptured the 200 and the 50-day moving average. I would even add this little red candle that we got yesterday. Yeah, it's a red candle because we closed lower than the open, but we still closed higher than the prior day's close. So that is now 8 consecutive up days in the S&P 500. I'm not sure the exact number. I'm seeing that this is the biggest win streak in 2 years. If there is a 9th day, I think that would be the biggest win streak in like 15 years. I don't know the exact phrases. But look, guys, we're due for a sell-off here at some point. Nothing goes up forever. 8 days in a row, 9 days in a row, whatever it is. Market's starting to get a little frothy. Whether we turn and head sharply lower or whether we just have a little bit of a sell-off and then continue higher is anybody's guess. The Dow is currently up 86 points right now, about 0.25% higher also, and the NASDAQ is up 13 points or 0.1% higher ahead of the opening bell. So we got all three indexes are in positive territory in pre-market trading right now. Let's see, I got a little ahead of myself here. Let's look at the commodities board, shall we? The gold, December gold futures at 1954. Gold's had a rough couple of weeks as the stock market has been rising. We're down 3.6% or 0.2% lower. Guys, I would just add that some people have been saying what we're seeing is a flight to safety. That's why we've been seeing bond yields falling as bond prices rise. People have been seeking safety in the bond market. If we were really getting a flight to safety, I would have expected gold to perform well along with bonds, and we're not getting that. Gold has actually sold off about $50 over the last few days. And also stock market going up 8 days in a row. That sure as heck is not a flight to safety. So there's a lot of people who are trying to explain away this surge in the bond market, this dip in treasury yields as a flight to safety. It just, that shoe does not fit. Stocks don't go up in a flight to safety. Gold doesn't go down in a flight to safety. This has very much been a risk on move in the stock market these last few days. December gold futures at 22.68. That's down about 4 cents or 0.18% lower this morning. Platinum and palladium are both down. Palladium down 3%. Guys, palladium has had a brutal couple of weeks. And, you know, that's one of your more, well, I mean, that's a purely industrial precious metal there, right? Palladium is used exclusively in high-end industry applications, also namely catalytic converters. So to see palladium selling off so severely these last few days, that's a very bad indicator for the global economy. Also, oil, I mean, speaking of bad indicators for the economy, oil has been getting crushed. Looking a little better today, December WTI futures trading at 76.22. That's up about 90 cents or 1.14% higher. Let's talk about oil a little bit. This one is in the news this morning. The Saudi energy minister blames speculators for the oil price drop. Prince Abdulaziz bin Salman says oil demand is healthy and rising OPEC exports isn't a sign of increasing production. Oil demand is healthy and speculators are to blame for the recent drop in crude prices, according to a guy who benefits if oil prices go higher. It's not weak, Prince Abdulaziz bin Salman told reporters in Riyadh when asked about the decline in oil prices. People are pretending it's weak. It's all a ploy. That's interesting. Tinfoil hats, anybody? All right, we're donning the tinfoil hat. This is all a ploy. The minister said some participants in the oil market have been misunderstanding increases in oil exports in recent months from Arab nations. Shipments are seasonal and tend to dip in the summer, then rise again in September and October, meaning they should not be viewed as reflecting fluctuations in output. It's abuse of numbers to fail to distinguish between rising exports and rising production. So it's all a ploy, according to the Saudi energy minister here. I'm not so sure that would really explain the big inventory builds that we've been seeing in the U.S. So I'm a little hesitant to buy into this "it's all a ploy" thing. Now, I would add there has been some political ridiculousness around oil prices in the last year, and there are certainly political motivations to keep oil prices lower, obviously. So I wouldn't discount it outright, but here's the one takeaway here. If the Saudi energy minister is saying prices are being manipulated lower, let's not forget that this is the guy who's got his hand on the valve that controls most of the world's oil supply. So if the Saudis are starting to get a little nervous about prices falling, keep an eye on that rhetoric. That could mean we could see another reduction in supply that could send prices back higher. And I just want to add, we're going to ditch the tinfoil hat now. I just want to add, we're still slightly above where the Saudis have cut production in the past. The last few times we got down into the high 60s down here. This is where the Saudis started cutting oil production and the Russians started cutting oil production. So we're still about $10 above that level. But if we see this sell-off continue and we start to approach this red line, that's when I would start to get nervous about possibly more supply reductions coming out of the Middle East. And also keep in mind, guys, the geopolitical situation is obviously favorable for higher oil prices. It's just a matter of right now, the concept of demand destruction is in the driver's seat. That could pivot to supply disruption any day. All right, let's take a look at the U.S. dollar. We've got the Dixie is 2 basis points lower at 105.57 this morning. And taking a look at the bond market, the 30-year Treasury is up almost 5 basis points at 4.70 right now. The 10-year Treasury, 4.564. That's up about 4 basis points. 2-year, 4.961, up 2.5 points. And the 1 month at 5.39. Let's take a look at, where are you? I have my 10-year Treasury chart here. All right, we lost the 50-day moving average a couple days ago here in the 10-year Treasury. A lot of buyers came in off the sidelines and started buying U.S. Treasuries. Guys, I think this is more speculation, not to sound like the Saudi energy minister here, but I think this is a lot of people speculating on the Fed here. I don't necessarily think flight to safety. You wouldn't see the S&P rally 8 days in a row in a flight to safety. You wouldn't see gold selling off in a flight to safety. This is people trying to front run the Fed is the best explanation I can come up for why the 10-year yield is falling. It certainly isn't because Janet Yellen is borrowing $2 billion less than everybody was afraid of. So I'm still not quite buying this decline in 10-year Treasuries. I'd need to see this thing head lower and stay lower for a while before I really buy into it. Although obviously we have seen a break in this trend line that we saw for most of the summer. We're now below that one. So that's important to keep an eye on that. We'll probably get a dead cat bounce in this one at some point also. And I would add the liquidity situation continues to deteriorate. This is reverse repos, currently at 1.024. This made a new low 2 days ago, guys. The amount of reserve cash on the sidelines that is available to keep these bond prices elevated and these yields suppressed, it is almost gone. And if anything, I see this chart starting to steepen. You know, we had these, I've been drawing the stairs down here for a while. You know, these steps, they're getting shorter and they're actually starting to angle down now before they head lower. So to me, this looks like a chart that's about to steepen, and we may have to move up our timetable on when the reverse repo runs out, currently scheduled for the middle of February. And if we are seeing the early innings of a liquidity crisis in the mortgage industry, see also that interview I did with Melody Wright yesterday, then we would see this curve start to steepen as the lenders start scrambling for cash because the pipeline of deals starts to slow down in mortgage-backed securities and margin requirements get jacked up. That will increase the demand for cash. We could see this reverse repo start to fall from there. All right, let's talk about some other things going on. I can't believe we're talking about this again, but here we are, just 10 days before another government shutdown. Congress expands to-do list with Ukraine and the border. I would also add Israel is on there. All right, let's not get involved in all the war spending debate and all that stuff. I think the debate itself is the story. The fact that we're back here having this stupid conversation again, that is the story. Not the reason why we're having the conversation, not the stupid debate between the rich should pay their fair share or we should spend less than we take in. Forget that. Let's not forget how we got here with these sharply higher yields and the U.S. credit situation. This is going back to August 1st when Fitch downgraded the United States long-term credit rating to AA from AAA. And I want to remind you guys of the reason why. In Fitch's view, there has been a steady deterioration of standards of governance over the last 20 years, including on fiscal and debt matters, notwithstanding the June bipartisan agreement to suspend the debt limit until January 2025. So has that situation gotten any better since the downgrade? No, it's gotten worse. The repeated debt limit, political standoffs, and last-minute resolutions have eroded confidence in fiscal management. Has that gotten better? Nope, it's gotten worse. In addition, the government lacks a medium-term fiscal framework, unlike most peers, and has a complex budgeting process. That's also gotten worse. These factors, along with several economic shocks, as well as tax cuts and new spending initiatives, have contributed to successive debt increases over the last decade. That's gotten worse, because now we've got another war that we're funding on top of all of these shock factors. Additionally, there's been only limited progress in tackling medium-term challenges related to rising Social Security and Medicare costs due to an aging population. Limited progress? What limited progress? There hasn't been any progress on that. So that situation has gotten worse. So all the reasons why the U.S. credit rating was downgraded in August have only gotten worse. We're headed back to this stupid debate again. So this is the problem I see and why I think this might affect the market. Not the stupidity of the politics, but the fact that we're even having this debate, I think could lead to further deterioration of the credit quality of the U.S. government, which could lead to higher bond yields. Whether we get another downgrade or not, it's just going to shake people's confidence in the government's ability to manage its finances. And to me, that says higher yields. So that's a story to keep an eye on. Now let's talk about the jobless claims, guys. Initial jobless claims in the U.S. decreased to 217,000 in the week ending November 4th of 2023. That's down from 220,000 in the previous week. All right, so this is initial jobless claims. And when you look at this chart, I don't really see anything to get too worried about here, right? I mean, if anything, this chart looks like maybe a slight trend down in initial jobless claims. So, yeah, maybe since mid-September, there's a little bit of an uptick. But also keep in mind, scale here, we were at 202,000, 200,000. Now we're at 217. So slight upticks, even though week over week we're down a little bit. But this is the chart that you should be more concerned with. This is continuing claims. Continuing jobless claims in the United States increased to 1.834 million in the week ended October 28th. That's from 1.812 million in the previous week. So we've got a jump up of about 22,000. Now take a look at this chart. Now you see what I'm talking about here. This is over the same period, right? Here's your initial claims. All right, we were higher in the early summer. We came down, kind of bouncing around in the mid 200s. But check out continuing. Since the first week in September, 8 weeks in a row, this thing has increased, and it looks like it's steepening. So it's not so much the rate people are losing their jobs that you need to worry about. It's the fact that the people who have already lost their jobs are having trouble finding work. And somebody who is on continuing jobless claims, that's someone who has been out of work for at least a month already by the time they're counted on this chart. So this is a lot of people now, 1.834 million people on continuing unemployment and rising. So keep that in mind, guys. We hear all about this strong labor market, tightness in the labor market. This chart says otherwise. People are, once they go off of the payrolls, we're having a hard time getting them back on. Now, let's talk about some of this is from the most recent job report. And I just did a quick summary of this for my buddy Travis over at Real Estate Mindset yesterday. He asked me for, like a 2-3 minute summary of the jobs report. And 3 numbers that were really important in the jobs numbers that we got on Friday, besides the headline 150,000 jobs added and the 101,000 revisions downward to the prior month. So we really only added 49,000 jobs. Almost all of those were government jobs. But it's the full-time, part-time, multiple job holders thing. That's what's also kind of worrying. We gained 326,000 full-time workers in the last jobs report, and that's something of a departure from the recent months where we have seen a decline in full-time workers. So we saw a recovery of 326,000 in the full-time numbers, but the part-time numbers, even though we've been seeing an increase in part-time numbers in recent weeks, we've been losing full-time and gaining part-time. We had a big correction in both of those numbers in this last jobs report. The part-time workers, we lost 670,000 part-time workers in the last jobs report. So almost double or more than double the decline, more than double the gain in full-time workers we lost in part-time workers. 670,000 part-time positions went away. And these numbers are already seasonally adjusted, guys. So this isn't college students going back to school or anything like that. That's already built into these numbers. And another thing that's very alarming is this multiple job holders number right now. There's 8.356 million people in the United States working at least 2 jobs. That's up 205,000 from the prior month. People keep having to get second jobs to make ends meet. So we've got increasing unemployment. We've got more people on continuing unemployment. Sure, we're adding jobs, but most of the jobs we're adding is people getting second jobs because they're broke and because their day job doesn't cover their monthly expenses. So the job market it's sending signals, but they're not the signals the press is telling you. All right. And I don't know how the stock market rallied off of this jobs number. How is this economy and this market and our financial system so backward that it thrives on the misery of the common person? That when we see numbers like this, the market just rallies for 8 consecutive days. Keep in mind, guys, if people aren't collecting paychecks, they're not buying stuff. All right. And stock market, that's companies that sell stuff. Right. Nobody's going to advertise on Meta if there's no reason to advertise because nobody can afford to buy your product. All right. Nobody's gonna need NVIDIA's AI GPUs or whatever stupid chatbot they're coming up with or deep fake image generating platform if nobody's got any money to sign up for a subscription for that. So at the end of the day, if people aren't working, there is nothing to support S&P 500 earnings and the market's going to fall. All right. Yeah, maybe Fed do this, Fed do that, maybe Burr, maybe not. At the end of the day, if nobody's getting paid, nobody's spending anything, guys. Also the housing market and the breakdown in mortgages recently. Last thing I want to talk about here, Bitcoin tops $37,000 for the first time in 6 months as optimism about a forthcoming ETF builds. Look, I like Bitcoin, guys. I like what Bitcoin represents. I own Bitcoin myself. I make regular buys of Bitcoin. There's a Swan link down below in the description. It's an affiliate link. All right, I use that every week. I buy a little bit. I put it in cold storage. I am suspicious of this move in Bitcoin. First of all, it's predicated on nothing. Bitcoin has rallied ridiculously over the last few months on fake stories about an ETF getting approved. There was at least 2 stories that I noticed that were just outright fake that, the SEC is any day now going to approve a Bitcoin ETF, or they already did approve a Bitcoin ETF, some people reported. Those were fake stories. Bitcoin rallied, and it didn't come back down when it proved that those stories were fake. All right, so I just want to remind you guys of the saying, buy the rumor, sell the news, because right now everybody is buying this rumor. Bitcoin is rallying like crazy on this rumor of an ETF. I mean, look, this is Bitcoin pretty much since, where was it? This was the first fake story right here in early October about the ETF. And look at what this thing has done in these last just couple of weeks. I mean, it's just marched straight upward on nothing. It's essentially nothing, guys, just a rumor. And if everybody is buying the rumor, that means when the story finally does break, if a Bitcoin ETF actually does get approved, well, it's already built into the price, guys. It's going to correct on that news. You're going to have people take profits when that story breaks. And I would just also add that the regulators are still cracking down on all the exchanges. We could have 2 or 3 more FTXs in the next few months if Digital Currency Group ends up getting prosecuted for. We learned a lot in the Sam Bankman-Fried trial about what was going on at Digital Currency Group, that they knew FTX was insolvent and did nothing about it, and that they actually tried to recover their funds instead of reporting it, which kind of makes them an accessory. That Digital Currency Group owns the Grayscale Bitcoin Trust, the largest holder of Bitcoin in the world. So there's no shortage of stories. Tether is still out there. Binance is a CF. There's no shortage of stories out there that could still take Bitcoin down. And right now I see Bitcoin rallying on rumors. Just be careful with this one. All right. I like Bitcoin. I make regular small buys of Bitcoin, but I am not FOMOing into this Bitcoin ETF approval story. I just don't buy it. All right. And I just want to say thank you very much to Mr. Getting Younger Every Day. Good for you. How do I get me some of that? Getting Younger Every Day says, great job, Jack, as always. A must listen for me every morning. Well, thank you so much, Getting Younger Every Day. I appreciate you having your coffee with the Melonhead, sir. And I appreciate the kind words and the support of the channel. Thank you very much. And thank you to my buddy Mike M. It was nice to meet you in Vegas at the Silver Symposium, Mike. He says, great video with Melody W. and must watch. I agree. Melody did an excellent job in that interview yesterday. I mentioned in the live stream yesterday morning that I needed to get a guest, somebody with a background in mortgages, to come onto the show. And I was actually thinking of Melody Wright when I said that on the live stream, but I hadn't reached out to her yet. So I didn't want to mention her by name and then disappoint you guys if I wasn't able to get her to come on the channel. But at least 3 of you commented that it should be Melody that I get to come on the channel and talk about mortgages. And it's interesting because I was thinking of Melody when I said that yesterday. And she was nice enough to come on the channel on very short notice and do that interview yesterday. That was very timely. Did a great job. Scary stuff going on in mortgages, guys. And it is, you hear nothing from the press about it. Nothing at all. The Mr. Cooper hack, the Meridian under investigation at Freddie Mac, the Fannie Mae sending all brokered loans to pre-review before they'll approve them. The crackdown on federal home loan banks, the increase in margin requirements at the DTCC for borrowing against mortgage-backed securities. These are all things that resemble the early days of the global financial crisis, guys, and nothing about it in the mainstream press. You get nothing but cheerleading in the mainstream press. And that's why you guys are here with us every morning on the Morning Update Live. Thanks again, Mike M., for your support of the channel, sir. And did I lose my audio? I don't know what happened. Anyways, guys, till next time, live small and dream big.